Bloomberg Audio Studios. Podcasts, radio, news.
Katie, it is ominous out there.
The skies are darkening as we speak.
It's Thursday at 2 o'clock and change, and will I get home?
Will you get home?
Will you get home?
Gosh, I hope so.
Each of us has to cross one or more rivers to...
That's true. There are bodies of water to ford.
Hello and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
I feel like we got feedback last week that people are like, please more ETF stuff, which is unusual for us.
I feel like maybe the people who leave comments are actually just contrarians. Like,
right.
We messaged...
They know that the default view is no more ETF stuff.
Yeah, and we messaged so heavily that people don't like this that they were compelled to write, actually, we like this, and here are our thoughtful thoughts on them. Well, but we're not talking about ETFs this week.
No, we're talking about...
a cousin.
Funds, yeah. Which are really, I mean, whatever. ETF is a term of art, but Is it a fund that trades on an exchange? Sure. But yeah, we talk a lot about, I read a lot about people who are trying to jam private stuff into retail investors. The people doing most of the jamming are the people doing like private credit funds. But the thing that the retail investors want the most is probably like SpaceX and OpenAI, right?
They're like, I don't want private bonds. Just give me SpaceX.
Yeah. Private credit is like sold by financial advisors, but like SpaceX is bought. And it's hard because you need to like go find shares of that. And I think a lot of people have in various ways had the thought, what if we didn't find shares, right? What if we just did naked derivatives on SpaceX or OpenAI stock or whatever, right? And the idea is you find someone who wants to be short OpenAI, and they write a contract saying, I'll give you the returns on OpenAI, and then you package that into a box and you sell it to retail investors. And then the retail investors get long OpenAI, and whoever wants to be short gets short OpenAI.
Yeah. You're just only exposed to the price action, theoretically.
And there's a certain amount of counterparty risk, sure.
Right.
Right. We've talked about people who do like various tokenizations, various things. And I wrote this week about River North doing these paired closed-end funds, which is like really the way to do this, like ultimately. It's a paired closed-end fund. And it's on this index it's like the Prime Unicorn Index, which is sort of an index of big private companies.
Sort of.
There's some public companies in there too, to keep it honest.
2 of its top 10 holdings are public companies.
Well, maybe they don't update that frequently or something.
This is as of July 16th.
No, but like...
Oh, they don't rebalance.
Yeah. Like, you have some unicorns in your index, they go public.
Sure.
But right, so it's got like SpaceX, it's got some Anthropic, it's got some of the hits. And what they're doing is they are writing cash-settled swaps on that index, right? The index measures, let's say, the value of these private stocks and public stocks, right? There's some questions about how you measure the value of private stocks, but these companies, there's like secondary trading, there's funding rounds all the time. It's fine. You can like get a value. And then they have the index, so they have the price, and they have just cash-settled swaps on that index, and you can go long or short. So there's a long fund that gives you exposure to this unicorn index, and there's a short fund that gives you negative exposure to this unicorn index. And the obvious trick is they completely offset. So net, nothing happens, right? Net, it's like if someone wants to go long and someone wants to go short, then we issue shares to each of them, and poof, we have both a way to invest in private companies and a way to short private companies, which some people want, right? Some people think it's a bubble, et cetera.
Yeah.
And so you get 2 delightful products to sell to retail without doing any economic activity outside of it, right? You don't have to buy shares. You don't have to do anything. You just offset retail bets against each other.
So typically when we talk about closed-end funds on this podcast, we talk about...
Which you do.
We do,
Not as much as ETFs. But...
We dabble. We often talk about how they trade at discounts. Does that matter at all here? That these are going to launch and then probably trade at a discount?
I have no idea how they'll trade. In fact, there is history of unicorn-y closed-end funds trading at huge premiums, right?
Right. So they'll trade at some dislocation. Maybe it's not a discount.
Right. If you look at the structure of this, there's like some stuff that suggests it shouldn't be too dislocated. So one thing is like they are termed cash-settled swaps. So this settles in 2027, I think. the termination date is not clear, but it's 2027 is in the name. So like this is a thing that like you buy it and in 2 years you get a payoff. So only so much discount you should really demand because you'll get your cash back in 2 years. And then the other thing that is interesting for discounts and premiums is like there are these two offsetting funds.
Right.
So like if they both traded at a discount, you could buy both of them and then you have a really interesting instrument, right? If you buy the long fund and you buy the short fund, both at a discount, then you basically have captured the discount, but you have 2 years of counterparty risk, weirdness risk, swaps risk. But like, fundamentally no market risk, I think, probably. This is not investment advice.
I hope these launch. I mean...
Yeah. And if they do trade at a discount, like my first PA trade in 20 years will be buying both of them and holding them to expiration. Yourself. I will definitely not do that, and it's not investment advice. I might do that just for giggles. I wrote last week about auction rate securities, which is like my only PA trade ever was when I was a banker, and like the auction rate securities market got dislocated, and so I bought one lot of auction rate securities. Yeah, you did. At like a 7% yield. I was like, oh, look at me living dangerously. God. That did work out for you, though. Oh, yeah. I made 7% for like a week. All right. Yeah, that was good. That's pretty good. I didn't lose money. Half a thought I had, because I live in ETF land, is, we talk about inverse single stock ETFs, and there's some element of volatility drag there. And if you hold these long term, then it could be painful. Is there any funkiness that could happen on the short side here? The inverse ETF problem, the volatility drag problem, comes from rebalancing. Yeah. The rebalancing exists because every day you are offering the ETF to people. And you want to give them down from today, right? And so you're rebalancing to get the right amount of exposure. With this thing, it's just swaps. It's a little easier. They're not leveraged. And you are not giving them like down from today. You're giving them like, the total return over the period. So I don't think there's too much in the way of volatility drag. There's some possibility that something can get funky if like the index goes up a lot. There's like a cap on returns. Like there's some possibility of weirdness where if you buy the thing in 6 months, you're not getting quite the negative 1 times exposure you wanted, which is like the opposite of volatility. The volatility drag exists because every day you're getting exactly the same proposition, which is like -1 or 2 times or whatever the ETF's exposure. And like here, there's not that. Here, there's just like, there's a term to swap and you can buy in at any time to the swap. Or even you can't buy it at any time because it's a closed-end fund, so they don't have to do the continuous offering. But no, it's very simple. And, like it's based on this index. Yeah. I think in large part because it's nice to have a third-party calculated index for your cash-settled swaps. So you can be like, oh, the thing settled at whatever the price of the index is today. Like, and someone else is doing the index. But if this works, you could do it for single names. You could do it for OpenAI. You could have the inverse OpenAI fund and the yes OpenAI fund, and you should offer that to people with no financials. I don't know. It seems like a stretch, but we're in a brave new world of like, it's not clear what securities regulations apply to anything anymore. And if you wanted to do a single stock closed-end fund, that's just like betting on and against a private company. Could you do that? I mean 2 years ago, I would have said no. Now I'm like, yeah, I don't know, maybe. These closed-end funds do seem like a stepping stone to that reality. So, yeah. They're very close to that reality. I mean, we talked about XYZ, right? Or the Destiny Tech. Yeah, that's the closed-end fund that has private companies and trades at a huge premium. And we talked about how, like Stripe, for example, or some of these private companies would not love this. Yeah. So I would imagine that they would also theoretically not love this either, even though we're talking about swaps here. I mean, with Destiny, like... Were they using forwards? They owned various cats and dogs, but like one thing they owned was like forwards on stock, which is like, those forwards are physically settled, right? Those forwards are basically someone who owns Stripe stock signs a contract saying, I will give Destiny my Stripe stock as soon as I'm allowed to, right? Like when Stripe goes public. And the reason they do that rather than just selling the shares is because Stripe doesn't let them sell their shares, right? They have some transfer restrictions. Stripe and probably every private company that transfer restricts its shares probably says you can't do a forward contract, right? Like forwards are to Stripe no better than selling the shares right now. And so it's not clear whether these forward contracts are valid. And If they're not valid, then bad things could happen, like Stripe saying, no, we get that stock instead of it going to Destiny when, Stripe goes public and they settle the forward. Here, there's Stripe gets no say. That's right. The private companies get no say. They're not involved at all. There's no contract on their stock. Nobody has to own their stock at any point. It's just purely a cash settled side bet between two people that don't involve the private company. So there's not a lot they can do.
Yeah. And that's sort of what I was getting
at.
They
can put out a statement being like, we're not involved and you shouldn't do it. But that's not, they can't stop it.
It might be like an annoyance rather.
Yeah. I mean, it's not going to change their lives at Stripe or whatever. But it's,
I did like that you make the point, though, that if you're buying into this closed-end fund, you're not funding a private company. Yeah. You're not giving your money and
put it.
Yeah, exactly.
This is the thing,
it's
man.
just the price
just
action.
Gambling, right?
Yeah. That's truly the reality that we're stepping towards.
I mean, it very much is. And people want to gamble on private companies.
God bless them. You know who doesn't want to gamble? UBS clients on range target profit forwards.
They don't now because they lost.
That's true. Bigly, apparently. The FT has really owned this story.
Yeah. So UBS, I don't know. I don't want to blame UBS. As a former derivative salesperson, I sympathize. Banks sell derivative products, right? You work in FX, right? And the thing you do is clients come to you and are like, I would like to change my Swiss francs for dollars.
Sure.
And you're like, okay. And they'll be like, how much will that be? And you'll be like, 0.0001 basis points or whatever, right? You charge them the teeny tiny amount of money. And so you spend all day in the lab cooking up things that could be more expensive, right? You're like, what if? And you try to give them a product that sounds cool. And there's only so many products that can sound cool. But what they were doing is, I don't know, it's got names. It's like a conditional target redemption forward or a range target profit forward.
Yes, RTPF.
Yeah, whatever. Anyway.
Household name.
The thing they were doing is basically we will sell you dollars. It seems to have been European, Swiss, whatever clients buying dollars, right? So UBS is we will sell you dollars at 0.3% below the forward price. So you're getting a bargain. But if the actual price in a month or whatever goes below that target price, we will sell it to you at that target price. So you'll get not a bargain. You'll get a bad deal. You'll be buying above market. And we'll sell you twice as much in that situation as in the good situation. Mm-hmm. So basically we will sell you dollars at a better than market price most of the time. And then some of the time we'll sell you many more dollars at a much worse than the market price.
Right.
So basically the clients get a good deal in 80 or 90% of scenarios. So you have a good thing to sell them. You're like, oh, look, you're getting a good deal in
I want to go out and sell these. Scenarios.
And then they get a terrible deal. They get really hosed in 10% of scenarios. And unfortunately, the bad scenario came true. And all the clients were like, we didn't know what we were signing up for. And UBS is sad and sorry and has made, apparently the FT reported, made more than 100 goodwill payments.
Yeah.
Which basically is a refund of the money they lost. Or
we're so sorry. Refund. Please don't leave us. We won't do it again. It's
not just the money. It's that the UBS banker has to go to the client. And the interviewed client is he didn't even bring any materials. It's they just go and look you in the eye and are very sincerely sorry. And they're we're not even pitching a different derivative today. Today we're here to just talk about how sorry we are. It's a really touching moment.
Yeah.
And they also have internal trainings where they're being told not to scam clients.
And also role playing, how these meetings should go from now on when you're pitching.
Right. It's this great tension in investment banking where obviously you want the client who, when you come to them with some crazy derivative, they're like, okay, sure, sounds good. And they don't bid it out to get the price down or model it up themselves. They're just sure, I trust you. Right. But those people are really good clients and they make you a lot of money until something goes wrong. And then it looks bad in court,
Yeah.
The client who really trusted you, the client who was not sophisticated at modeling, FX volatility. Those are not the clients that you want to go to court with. So it's a delicate balancing act where 2 years ago, UBS was probably rewarding the people who brought in the less sophisticated clients in large size. And now it's no more of that.
Well, the FT gave some great examples of the harm that was wrought by some of these trades really kind of blowing up. one client lost more than 3 million Swiss franc, which equates to like $3.7 million. Another person said that they lost 15% of their assets. They also asked the bank to exit the investment a few days after Trump's Liberation Day. And apparently, according to FT reporting, UBS sold these products to customers with the equivalent of fewer than $800,000 or so. So I don't know. It's just a weird trade in general to put on. Like, this sounds like something like if you were a big business trying to hedge your currency exposure, maybe this would make sense. But selling it to even like very wealthy individuals is weird.
Yeah.
Like the way that the FT describes it is that these products offer limited upside, but expose clients to potentially unlimited losses.
Yeah, but that's everything. That's like accumulators. It's like everything, right? It's like the trade is...
everything except buffer ETFs, baby.
I know, but like for so many wealthy clients, the trade is like you can get 2% more on your money by like taking some black hole of risk, right? And then, you have the meeting and they're like, but what do you think the chances are of that black hole of risk happening, right? And the client's like, oh, it sounds good, right? And they buy it and they get 2% extra yield and then like the black hole happens and they're very sad.
Yeah.
Here the black hole was Liberation Day tariffs and the dollar plunging.
I will say you were talking about the sympathy that you feel towards, these bankers who make these derivative products.
I don't pretend
no, I think that's cool and
very
awesome.
Moral of me.
That's
but
fine.
I was one of them. I only sold to sophisticated clients.
Right, for sure.
None of them got their faces ripped off. I'm not even kidding, really.
No.
Well, I'm kidding a little bit. Like, none of them got their faces too. Well,
someone's going to write in and say, Matt Levine
ripped
me.
my face off.
But
I really didn't. I was also very ineffectual, so it was fine.
My first beat at Bloomberg was covering FX as a little baby journalist. Mm-hmm. And the period that I was covering FX, there was no volatility in currency markets. You had to beg people to read your stories and also like really scrape the bottom of the barrel to find stuff to write about. I joined Bloomberg in like 2016 and stopped covering currencies in 2019. So President Trump's first term actually gave us something to write about. But, this trade probably wasn't as risky. Like it probably really was fine 90% of the time because the type of volatility that we saw in the Swiss franc dollar exchange rate on Liberation Day, like that wasn't happening for a long time. Like, I mean, you saw it across asset classes.
Like, what does that tell you, right? I mean, like if this trade had been perfectly explained to like clients who were not professional FX traders, but were smart and sophisticated, financial people, this trade had been perfectly explained. Like the perfect explanation is in the ballpark of like, you will get some extra, yield or profit or whatever most of the time. But if the dollar plunges, like it does not usually plunge, then you'll get your face ripped off.
Yeah.
Right? And like some people would have been like, okay, I'll take that bet. And then the dollar plunged and then they got their faces ripped off.
Yeah.
And so, like I've read about this before. Like there are clearly some customers who did not understand what they were getting into and naughty of UBS to sell them something they didn't understand. But also, like, probably some people were like, I will make the bet that the dollar will not be super volatile. And the dollar is super volatile. And I lost my bet. But, like, look, everyone else is getting a goodwill payment. I actually get a goodwill payment, too.
Yeah. I mean, you would think that they would happen potentially across asset classes. Like, every asset class had an outsized move on Liberation Day.
Right. And there's something about FX where people, smaller customers get sold weirder stuff. Like, I mean, there are definitely equity trades like this, right? Like we've talked about, like, is it the accumulator? We've talked about like structured note trades that kind of have this shape, right?
Yeah.
But I don't know. In FX, it does seem like people take more random gambles. And also like people don't expect as much volatility. And then, when they get volatility, they're very sad.
Such a strange market. It was a fun trip being there for like 2.5 years.
Right. If you're in like the business of selling equities, there's a lot of like, you can do buffers and stuff, but there's a lot of just like, ooh, buy OpenAI. It's a good stock, right? If you're in the business of selling FX, like you're kind of instantly going to weird derivatives.
Yeah. Yeah.
And sometimes they blow up.
Which leads us to insurance.
Insurance sometimes blows up too.
Yeah. Well, trying to get us to hurricanes somehow, but I can't quite make the metaphorical jump. So anyway, demo
in 10
tech.
minutes, I'm going to make a literal jump into the hurricane here.
Oh, because it's raining in New York.
It's raining in New York. And like, they've already preemptively shut down all transit.
Well, all the subways keep breaking.
Right. I have to take a subway and then a train. It's going to be bad.
My dad is picking me up today, so I'm happy.
Okay. So
Florida.
So there are a lot of houses in hurricane zones. It's hard and expensive to buy insurance on your house if it's in a hurricane zone.
Mm-hmm.
People have jumped into the gap to meet that market failure. Conceptually, the way you do it is you start an insurance company and you don't have any money and you start selling insurance policies to raise money, right? And if you do this for 20 years without a hurricane, you'll have so much money that you can pay off any claims, right? But if you do it for 1 year and then there's a hurricane, you will not have so much money that you can pay off any claims. And so there's a risk in starting a new, I'm dramatically oversimplifying, and in fact, new insurance companies are supposed to be well capitalized, but conceptually, you start a new insurance company, you raise money by selling premiums, and then if there's no hurricanes, you're great, and if there's lots of hurricanes, you go to zero. And that's hard to do because insurance companies have to be rated. There's a couple of big ratings agencies. And there have been a number of stories recently. There's one in the Wall Street Journal this week, and Bloomberg wrote about it last year. There's a ratings agency, it's like a mom and pop operation called Demotech that rates a lot of smaller, less well-capitalized insurance companies and gives a lot of them A ratings, and they have a higher incidence of their A-rated companies becoming insolvent within, a reasonable period of time.
30 times more likely.
30 times more likely than the other ratings agencies that use more traditional methods.
Somewhat meaningful.
And it's like, why does this exist? Well, people want to buy insurance. Someone sent me, there's a Monty Python skit where a reverend comes into the insurance office and says why aren't you paying my claim? And he's like, oh, you see, you bought the never pay policy, which never pays off. It's a great policy if you don't have a claim, but if you have a claim, it never pays.
Ugh.
It seems like people want the never pay policy.
Yeah.
I've written a little bit about why. And it's an interesting systemic answer, which the answer is that these insurance companies have enough money that if you burn your house down by accident, they'll pay your claim. Mm-hmm. They have that kind of money.
Yeah.
What they don't have is the money to pay off everyone's claim if there's a big hurricane.
If a town is wiped out.
Yeah. And why would you want to buy insurance that protects against you accidentally burning your house down but not a hurricane? The answer, I think, is that you probably correctly believe that there's some sort of bailout coming if your town gets wiped out.
Yeah.
And in insurance, this is really quite literal, where there's state guarantee funds that basically will step in to cover wiped out insurers. So if you're a homeowner, you can buy the bad insurance policy figuring, either it'll pay out or if it doesn't pay out, someone else will step in to pay it out. And then there's a question of why do states allow this? Because the states fund the guarantee funds and they're on the hook if this insurer doesn't pay out.
Yeah.
I think the answer is that's a problem for another day. And right now it's nice to have insurance, right? So if you're a Florida politician and people can't get insurance to buy houses in Florida, that's really bad for you, right?
Yeah.
And if they can get insurance, that's good for you. And if the insurance doesn't pay out and the state government has to step in to guarantee the insurance, that's a problem for later.
Yeah.
And so there's a certain amount of short-sightedness where regulators, politicians are all happy to go with a system where the insurers are not necessarily all that well capitalized because that's a problem for someone else to figure out later on.
Yeah. This is not the same thing, but it kind of reminded me of the conversation we were having about Egan-Jones a couple months ago. That is the ratings agency that basically gives pretty high ratings to private credit investments and has a track record of a lot of those private credit investments not going so well. Or, you think about it gave pretty good ratings to Chicken Soup for the Soul. It gave good ratings to Redbox, and those went belly up. But there is a space for these rating agencies.
Yeah, it's a similar dynamic in that ratings are not really for the consumer of the ratings, right? You're not getting insurance from an A-rated insurance company because you want insurance from an A-rated insurance company. There's some sort of regulatory backdrop. Mm-hmm. And so if ratings are kind of generous, a lot of people are very happy to have generous ratings. And so there's a market niche for people who are willing to provide generous ratings.
Yeah. And it's all just future problems to deal with. So
yeah, everything is A-rated now.
Yeah.
Hasn't defaulted yet.
Yeah.
Right? Who knows what'll happen?
Hey, so this episode is coming out on August 1st. And in August, people, including Matt Levine, take vacation. So we're going to do another mailbag episode. So make sure you send us your cool questions, moneypod@bloomberg.net. And there's a pretty high likelihood that we'll answer some of them. Matt, I know
we might do a mailbag episode.
We might.
There's a medium probability we'll answer.
If your questions are good enough.
Don't go nuts.
If your questions are good enough, we will do a mailbag. So it's up to you.
That's not even... Yeah, sure. It's up to you. It's all riding on you. And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Andam.
Our theme music was composed by Blake Maples, and Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.